Hello, everyone, and welcome to the weekly roundup. Today, Ben will be discussing prospects for interest rate cuts, recent inflation numbers, and latest corporate news. Hello, Ben.
Hey Eva,
Happy Friday.
happy Friday. Sun shining, but only during the week.
Oh, yeah. Okay, we'll start off with global interest rates. The FOMC is shifting their gaze to labor market data rather than inflation data. Beijing remained dovish, and here in Canada, markets is starting to signal more rate cuts. Would you like to unpack all of this for us?
Yeah, sure. I'll do my best on that one. I think obviously coming into we had last week, we had a bit of a volatile week with correction, lots of changes from the expectations with the US central bank and the FOMC. Monday, Tuesday, we had probability of a rate cut in September of around 100%. That's eased a little bit since then, but we still expect the U.S. central bank to cut. There was some more data that came out this week that showed that it was softer. Things were softer than expected. Housing starts, permits were softer. There's a couple of charts that'll show when we go through on the charts, but certainly the U.S. data is softening. We also we met with a fixed income manager this week and we spoke about the Canadian market, the Canadian economy, which I found was quite interesting because their view is that the Canadian economy is slowing significantly faster than the US and think that they're going to cut interest rates regardless of what the US does. So that was a bit of a different take. But
Yeah.
still, I mean, the market's still anticipating rate cuts from both Canada and the US in September. And then your last question about China was, I think they'll do whatever they have to. Their economy is slowing. The housing market is a big chunk of their economy, and a big chunk of most Chinese people, they have something like 70% of their wealth in real estate. So cutting rates and stimulating is something that I think China will do. And historically, the back half of every year, they've stimulated, and we saw a few stocks, JD.com and Baba, kind of their internet, like their Amazon equivalents, been rallying this week on kind of positive consumer sentiment in China.
Okay. Let's go back to inflation a bit. We saw it cooling in the US. What does it mean for the economy generally and rates and, the macros?
I think it supports them to cut rates. Last week, I think I put the slide up just about expectations of something in the neighborhood of 8 cuts, which is effectively a 2% cut in interest rates over the next 12 months in the US. So if the data continues to soften, then that'll be the case. Um, you know, Market, I think, has been a little bit choppy just around the two president candidates talking about what they're going to do with potential tax cuts, with potential subsidies. And I think that's spooked the inflation market a little bit because Harris has been talking about cutting taxes and forcing lower prices, but ultimately that'll result in higher inflation. But so I think that spooked the market a little bit. But if we continue to see weak data, then gives the U.S. central bank more room to cut.
Okay.
Yeah.
On the corporate side, pockets of interesting releases. We saw Scotiabank's US stakes, Starbucks shakeup. What was in the corporate news this week that's worth noting?
Yeah, those two are interesting. I mean, Scotiabank's been focused really on international markets, and typically they've been focused on Central America, South America, and now we see them pivot a little bit. But they invested with KeyCorp, which KeyCorp is a high quality regional bank. I think they're based out of Ohio. So it's interesting at this point of the cycle that they decide this is when they're going to do it. Um, for me, outside looking in, it's a bit counterintuitive. Um, if you expect the economy to get soft, You probably get the US dollar weaken, and that should be good for international markets, emerging markets, as opposed to buying into the US. So the decision's a little counterintuitive to me at this point. I thought they would have doubled down on their current exposure internationally, but I guess they feel like they need some exposure to the US. So interesting. Starbucks is, I think, really struggled. They announced the new CEO, which is the fourth CEO in 2 years. So once Schultz left, and he was the founder of Starbucks, once he left, they've had a hard time replacing him. And oftentimes that's the case with founders. And so the person they brought in is from Chipotle, and he's been doing quite a good job, apparently there. And Chipotle is one of the top five fast food places in the U.S. presently. Big part of what he's done to lead them there. So market liked the announcements both ways. So Chipotle obviously went down on the news, and Starbucks was up about 20% on the news. So that those two were quite interesting announcements this week.
Okay, great.
Mm-hmm.
Anything else catch your eye this week?
So on the corporate side, not too much really. Those are big ones. Corporately, not really. It's just more been the economic data right now, and we've had a pretty good rally off of the correction Monday and Friday. So I've thought, okay, what and where do we go from here? Because it's really snapped back quite quickly, and the market looks a little bit overbought here, but been hanging in today with the low volume like we talked about before, because everything seems to be quite quiet. So it'll be important to watch, but nothing else really jumped out at me on the corporate side.
Okay. Do you make any changes in portfolio this week?
No changes. Certainly continue to review the bond exposure, particularly on the longer end. Came into the week, traded down a little bit, but as we finished the week, last 2 days here, we've seen long bonds move higher in both Canada and the US. We've seen rates fall pretty quickly in Canada over the past week, something like 60, 70 basis points from Monday last week. So we'll be interested to see how that plays out and if we need to make any adjustments. A few names that hadn't been looking at buying have come to the top that I've started to look at, but haven't made material changes just yet. Have a small position in the yen for clients and may look to sell that at some point. It's had a nice move, but generally been waiting here, saying let's wait and see what we do.
Okay. Let's go into the charts.
Charts, okay, excellent. Just let me know if you can see that okay.
Yes, I can.
Okay, perfect. All right, so we had some numbers come out this morning. So I think we've had a bit of a mixed week. We had retail sales out yesterday. Everyone seemed a little bit excited about that. Then we had new information come out again this morning, housing starts and building permits. And so I thought this was a great chart just to look at really where we are from a perspective of is the news good or is the news bad? And so we look at new orders. We look at one of the things I think that jumped out to me here was certainly prices paid versus prices received. So obviously you don't want that. You want the opposite direction, where prices received are higher than prices paid for companies. So 1 month change as well was dramatically negative. New orders and shipments, quite a quick slowdown. Delivery time is slowed. Number of employees, this is a pretty material adjustment as well. So I guess the headline news probably isn't as good as you would think it would be. So headline news isn't always what you need to look at. So I think it's a little bit looking below the surface here and saying, are the numbers that are coming out good or bad at this point? The other one that I think is always worthwhile is just that inverted yield curve, because we've been in this environment for an extremely long time. probably the longest in history where we've had the inversion where the 3 month is higher than the 10-year. And so now we're starting to creep back up to maybe a flattening of that curve. And it'll be important to watch. There's different points on how long it takes. The last time it took this long was 1929, so hopefully we don't have that same backdrop as we did back then. But this is going to be extremely important to watch, see how the curve flattens, and we'll watch and see how that plays out. A couple of more just quick ones. This is around the profit margins of the grocery stores. So again, I think it's important to look below the surface and say, are they actually gouging us? Or are they actually gouging people? Or is it something else potentially along the supply chain or other things that are causing the prices going up? And so this is Kroger, which is a big US grocer. Their profit margin is 1.43%. So, that's not very high. Of course. So I think, as you talk about, price controls and so on, I think that is limited shelf life and limited the ability for anyone to actually put this in place. It'll put the grocery stores out of business. So maybe there's something else they can do, but I think it was important just to pull this to your attention because it's not necessarily what is being said on the news. And so this is the S&P versus Euro stocks. And so, we go through a lot of different periods of time in the markets. I've been investing professionally for 24 years now. And so I started my career here just as we kind of peaked in 2000. And so the orange and blue lines, they were quite connected. But what's interesting, I think, to remember is that we went through a decade here of not making money in either of these asset classes. And then we've had a huge acceleration in the S&P 500 versus the Euro stocks, which has primarily been sideways for this decade. So it's, I think, mostly an important reminder to say, what do we do at this point? What do we do with this information? Is the US market the only one that we need to be invested in? Or potentially, does this make sense to look at some of the other areas that are much cheaper, pay higher dividends, and potentially a little more attractive? Not saying it's the case, but this is a huge spread. It's something that we haven't seen pretty much forever with these two indices and markets. So effectively, it's Europe versus the US, and the US valuations have been kicking butt here. So important just to think about risk and what to do when you're investing into these markets. That's it for the charts today.
Great. So what are we looking at for the week ahead?
So I think it will be interesting to see how things follow through this week or next week, excuse me, because we had a big correction, then we had a big reacceleration. My expectation is we get a bit of a correction in markets next week. And so it'll be interesting to see if that follows through with equities and what happens with yields, because we've had a bit of a move here where yields have been sideways to up and equities have been up. So it will be interesting to watch that. The other case, of course, is gold has hit a new all-time high. Not inflation adjusted, but in actual dollars, an all-time high today. So it'll be worth watching to see if that continues to follow through and see what we do from there. My thoughts align more with the fact that maybe things are starting to get a bit more expensive again. And, we've talked about the puts. And so I think I'll be reviewing that, seeing if it makes sense to put those on in portfolios at this time. And some stocks rallied hard, so it may make sense to take some profits sometime next week.
Okay, great. Great. As always, please reach out to me if you have any questions or if you'd like to book a portfolio review meeting with Ben. Thank you very much for listening and have a good weekend.
Thanks. Take care.
Bye.